Max Life Flexi Wealth Plus Plan. Will this plan aid you in achieving your financial goals? Will this plan be a value addition to your investment portfolio? Let us see about that in detail in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to take the right financial and investment decisions to reach your financial goals faster and smarter. Max Life Flexi Wealth Plus Plan is a unit-linked, non-participating individual life insurance savings plan. In this video, we are going to see its features, the types of investment strategies it provides, the types of fund options available in this plan, various charges, advantages, disadvantages, its IRR analysis, and the comparison to it to other investment vehicles, and finally if you should invest in this policy or not. Now let us dive into the video. Now let us look at some of the features available in this plan. There are options to choose your policy term and the premium payment term at your own convenience. There are two variants to choose from in this plan. The option 1 is the wealth variant and the option 2 is the whole life variant. You also have a wide range of 11 funds and 5 investment strategies to choose from. Guaranteed loyalty additions and guaranteed wealth boosters will also enhance your fund value. And all the mortality charges you have paid during the policy term are returned to you at maturity. And unlimited free switches and 12 free partial withdrawals are allowed in a year. Now let's look at the 5 investment strategies available in this plan. The first strategy is called self-managed portfolio strategy. In the strategy, you can manage your investment by choosing among the 10 investment funds available in this fund in the proportion of your choice. In the second strategy, called the systematic transfer plan, it allows the policyholder to duplicate the rupee cost averaging approach on the policyholder's annualized premium. First, the units will be acquired in Secure Plus, and then on each consecutive monthly anniversary, units available in the Secure Plus fund will be progressively moved to the Growth Super Fund. The third strategy is a life cycle based portfolio strategy. Based on this strategy and based on the changes in your life, the policyholder can choose the funds to create a balance between equity and debt. The investments are distributed between Fund 1 and Fund 2 with their proportions varying as per your different life stages. And in the fourth strategy, trigger-based portfolio strategy, the strategy can help you to secure your gains because primarily this investment strategy distributes the equity and debt ratio of 75% to 25% proportion. At each monthly anniversary of the policy, the portfolio will be rebalanced and funds will be reallocated depending on a predefined trigger event. The last and the fifth strategy is called the Dynamic Fund Allocation (DFA) strategy. This strategy can help the policyholder to strike the right balance between debt and equity by rebalancing on yearly basis till the end of the date the policy matures. The funds will be divided between the Growth Super Fund and the Secure Fund in a predetermined proportion that varies according to the number of years before the policy maturity. There are 11 fund options in the Max Life Flexi Wealth Plus plan. The funds available in this plan can be seen through this table in the screen. So there are only debt funds and there are only equity funds and there are a mix of balance funds where there is both equity and debt funds, and there are funds which has a low risk category and there are funds which has a very high risk category. So based on your time horizon to achieve your financial goals and the risk appetite you have to take risk, based on these factors you can choose whichever fund you want to choose. As this is a ULIP insurance policy, there are several charges involved in this plan. So the first charge is the premium allocation charge. It ranges somewhere between 4 to 6% and you have to pay this for the first 10 years of your policy term, and there is no premium allocation charge after the 11th policy year. So the next charge is the fund management charge. For equity funds, it ranges between 1.10% to 1.25%, and for other funds, it ranges between 0.50% to 0.90%. And the discontinuance charge, like suppose you're going to discontinue from this policy, then you have to pay some charge which is subject to the annual premium and fund value. And also there is something called a premium redirection charge, which is free of charge. Like if you opt for other plans, or other ULIP plans, there will be something called premium redirection charge, but in this specific plan there is it's free of charge, and only 6 premium redirections are allowed in any policy here. And there is something called partial withdrawal charge also, which is also free of charge in this policy, and maximum of 12 withdrawals are allowed in any policy here. And there is something called switching charge, which is also free of charge in this policy. And there is something called mortality charge. This is also subjected to the your chosen sum assured and the age of the policyholder. So out of all these charges, the only charge I would consider something to be applicable or at least justifiable is the fund management charge, because to manage your funds, charging a particular amount is fine. And mortality charge is also like it's provided because they provide life cover to you, but as it also is returned when there is when the policy reaches maturity, it's also fine. But the charge that is not justifiable at all is the premium allocation charge, because it's an entry charge. Just to enter this policy, you have to pay that charge. Like suppose if you invest in a mutual fund, there's nothing called entry charge or exit charge, like the discontinuance charge. Nothing like that can be found in the mutual funds. But in this policy specifically, to enter this policy and to exit this policy, we have to pay certain charges, right? So these are not charges I find justifiable to be. And compared to other policies, it does have some charges free of charge, but the thing is, while it is free of charge, there is a restriction to how much you can do premium redirection or partial withdrawal. Suppose if you invest in mutual funds, there is no restriction like that, so that's also you have to consider. Now let's look at some of the advantages of the Max Life Flexi Wealth Plus plan. You have the option to choose from 2 variants, 5 investment strategies and 11 funds, and there are also guaranteed loyalty addition and guaranteed wealth boosters to increase your fund value. And the mortality charges you pay will be returned to you. And you also get unlimited free switches, 6 premium redirections and 12 partial withdrawals which are allowed in a policy here. You are also allowed to increase or decrease the premium payment term or the policy term. Settlement option can also be exercised during maturity. And some of the disadvantages of investing in this policy might be no liquidity in the first 5 years of the policy. And the loyalty additions, which I mentioned before, starts only from the 6th year, and the wealth booster starts from the 11th policy year only. So the loan option is also not available in this policy. So during the settlement period, the investor should bear the investment risk. It's not up to the company, it's up to the policyholder. So if you choose to invest in any policy, the main thing we need to consider is what is the return you're going to get from this policy. So from the benefit illustration given in the Max Life website, we have calculated the IRR for this specific policy. So to determine the IRR, we have to assume some things, right? Like let's assume the policyholder is a male who is 35 years old, and the policy term he has taken is for 10 years, for which he has to pay premium for 5 years, and the sum assured he will get is 10 lakhs, and the annual premium he has to pay is 1 lakh, and the fund he has chosen to invest is the balanced fund. It has both equity and debt fund, so it will be a mix of both, and the variant he has chosen to invest is in the wealth variant. So based on these assumptions, we are going to determine the IRR for this policy. So through that, the fund value at the end of 10 years at an assumed rate of 4% in the worst case scenario will be 5,56,594 rupees, and an assumed rate of 8% in the best case scenario, it will be somewhere up to 7,60,100 rupees. So please note these returns, these above assumed returns of 4% and 8% per annum respectively for the balance fund are not guaranteed. They are just assumed rate of return according to the Max Life website. So if you work out the IRR for both the scenarios, for the worst case scenario, it comes somewhere between 1.35%, and for the best case scenario, it is at 5.34%. So both these IRR couldn't even reap a bank savings account rate of interest, or at least near a bank FD rate of interest. So in the long run, it's not possible to beat inflation with these rate of return, and it's not even guaranteed. So it could be more lower than this, or at least a little bit higher than this, but as it's not guaranteed, we can't actually prove that this will beat inflation in the long run. So since this Max Life Flexi Wealth plan is a ULIP plan, it is appropriate to compare it with other market related investment. So let's assume a similar cash flow of like annual premium of 1 lakh rupees, and use this to invest in a pure term insurance policy for life cover, and the balance amount could be invested in ELSS mutual fund. So let us assume that the pure term insurance with a sum assured of 10 lakh rupees and a policy term of 10 years and premium paying term of 5 years has been opted. So the annual premium for this policy would be 8,000 rupees, and the balance amount out of this 1 lakh could be invested in a mutual fund ELSS fund. So now let's see at the end of 10 years, the fund value. What's the fund value is going to be? The fund value, which is post-tax return. We are eliminating the tax related charges, and only the post-tax return would be 10,94,262. So at the end, the IRR works out to be 10.16% in the post-tax return. This is especially beneficial to the investor in the long run, as this return is higher than the inflation rate. So in this combination, you can actually achieve a higher rate of return and also beat inflation in the long run compared to Max Life Flexi Wealth Plus plan. So are you still wondering if you should invest in this plan or not? Let us see what we can take away from that by our analysis. Max Life Flexi Wealth plan enables you to have flexibility in terms of the policy term, investment strategy, and fund options. But since this is an ULIP, it also has some complex charges and is not very transparent in its operation. The crucial factor to how you get low IRR is mainly because of charges like this, because it gets deducted before being invested in the fund, which in turn yields you low returns in the long run. So overall, we can conclude that investing in a ULIP like Max Life Flexi Wealth Plus plan is not going to add a beneficial value to investment portfolio. So it's a complete no from me. It's better to avoid this policy than investing in it. So if you're still willing to take some risk, then you have much better market related instruments in the market. As we have discussed before, you can invest in mutual fund that caters to your financial needs and also suits your time horizon of your financial goals. See, any insurance scheme which provides a combination of dual benefits will not be able to generate the inflation beating return that you're looking for. So it's better to keep both your insurance and investments separate to potentially yield better returns in the long run. To understand other investment alternatives, to better understand them, you can always discuss them with your financial advisor to see which will be the right fit for your investment portfolio. So if you have any doubts regarding this policy and you want to read about this in detail, there is a blog post about it in our website, for which you can find the link in the description. If you have any doubts regarding the topic we have discussed in this video, please comment so we can get back to your queries quickly. Also, if you have any doubts regarding mutual funds or any insurance policy in general, then you can always book a complimentary financial consultation with one of our financial planners to discuss about it, and the link is in the description to book your appointment with us. And if you want to gain more knowledge regarding financial investments and personal finance in general, we also regularly conduct live webinars, for which also you can register by clicking the link in the description. Also, if you like our content, please like, share and subscribe to our YouTube channel. Thank you.